Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. Today we're taking a look at 3 large cap stocks to consider buying at a discount ahead of their upcoming earnings releases. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look into our services, portfolios, and more. So before we jump into the 3 stocks, it's worth doing a broader overview to understand why things are trading at a discount heading into the all-important Q4 earnings season. So we're going to dive into the market. So the market closed on Monday in observance of Martin Luther King Day, and then we opened significantly lower on Tuesday after a rough report from Goldman Sachs. So Goldman Sachs saw its profits slip 13%, and the Wall Street Giant said that its fourth quarter trading revenue fell 7%. With this in mind, though, let's take a look at what to expect from the broader S&P 500 earnings picture for Q4 and then beyond, just to give a sense of the scope as people get a little more nervous and start selling more stocks as we enter the latter part of the first month of 2022. So overall, Zacks estimates are calling for Q4 S&P 500 earnings to climb 21% from the year ago period, with revenue set to climb about 12%. And then if we look for the full year, we're expected to jump about 46% on the bottom line and then 10.5% on the top line. This obviously comes against a really easy to compare period last year when things were weighed down by the heart of COVID, where earnings fell 13% and revenues were essentially flat. But we're calling for 46% growth and 10.5% revenue growth. And then crucially, looking ahead, we're calling for another 9.2% earnings growth in 2022 on about 8% higher sales, and then another 9.6% on top of that in 2023 on about 6% higher revenue. So continued growth, even as we come up against a big year in 2021. So these near-term setbacks need to be put in broader perspective, and we're still calling for growth despite the rising prices and supply chain bottlenecks and all of those other worries. With this in mind, stocks were down pretty significantly as of midday on Tuesday. So the Nasdaq was down about 2.1% the last time I looked, with the S&P 500 down around 1.8%, and we saw bond yields hit 2-year highs today, as investors might want to start considering, though, buying some of these long-term holdings at a discount. We're going to jump into maybe some broader reasons of why things are still relatively bullish, and why, though, you might want to consider buying some big companies that have a track record of being able to grow even during rough economic conditions while paying a dividend, buying back stock, and all of that. And really maintaining kind of a keep it simple, stupid portion of your brokerage account is really prudent at all times, and it's really paramount as the U.S. economy faces 40-year high inflation that might spur the Fed to raise its interest rates even more quickly than previously expected, which could further dampen already beaten down growth names in pandemic winter. So it might not be just the time to jump back into those beaten down growth stocks that are widely popular in Cathie Wood's ARK funds. So instead, you might want to just consider some big, huge names that are able to weather the storms, but have also been beaten down in the last month. So we're going to take a look at the first stock of these 3 big names that are all set to report in the next several weeks that might be considered mega cap stocks, depending on what your definition is. They're all around $100 million or $100 billion market cap or higher. And the first stock we're looking at today is actually one of the largest companies in the world, and that is Microsoft. And they report their Q2 FY 2022 results on Tuesday, January 25th, so a week from today. With this in mind, Microsoft really hasn't needed an introduction in decades. Nonetheless, though, the technology titan really recalibrated its long-term trajectory with its expansion into the booming cloud computing industry, and its ability to thrive alongside Amazon and others could help it grow at impressive rates for a company of its size and age. And cloud computing is likely to continue to fuel its top and bottom line expansion as the space expands throughout the world and in the US, and becomes a necessity for really every industry and company imaginable. And then obviously alongside its vital cloud efforts, it still has its Office and Windows units, and they remain highly valuable to really everyone from large enterprises to students. And then on top of that, the company's prepared for the hybrid work world with offerings that compete against Zoom and Salesforce and other of these non-email communication platforms. There's also its Surface business, Xbox, LinkedIn. The company's 2021 revenue climbed 18% to $168 billion, which came on top of 3 straight years of 14% sales growth, which is really impressive for a company that went public in the 1980s. Zacks estimates call for its FY 2022 revenue to surge another 16%, with 2023 then set to climb another 13% higher. So it's just rolling out years and years and years worth of double-digit revenue growth is really impressive. And then the high margin cloud computing business is expected to help its earnings continue to grow. We're calling for 40% adjusted earnings growth this year. Microsoft is currently projected to follow, or it posted 40% growth last year and expected to follow this up with another 15% expansion this year and then 12% stronger in 2023. The company's also consistently beat our bottom line estimates in the last trailing 4 quarters, and beyond that, the company has also seen its earnings estimates climb since its last report, and it currently ranks as Zacks ranked number 2 buy at the moment. We should also note that Microsoft is really a money printing machine. It closed last quarter with $130 billion in cash and equivalents, and the firm returned around $11 billion to shareholders last quarter via buybacks and dividends, up 14% compared to the year ago quarter, and it raised its current dividend payout by 11% in September. The company has also approved a new share repurchase program, which further highlights its financial firepower, and its impressive balance sheet and piles of cash could help it continue to make strategic acquisitions, both big and small. And you can tell I wrote this last sentence right before the news broke this morning, because Tuesday morning, with that in mind, its huge cash piles continue to make big acquisitions. Microsoft, news broke early on Tuesday that Microsoft was buying Activision Blizzard in an all-cash deal valued at roughly $69 billion in what appears to be a bet on the metaverse and VR gaming in general. The deal will be its largest acquisition by far to grab the video game powerhouse, and this was via reports from the Wall Street Journal this morning. But Microsoft, since that report came out, confirmed the deal via a press release. So the company is buying Microsoft's buying a company that makes Call of Duty, World of Warcraft, and a bunch of other games as well. So it's going to add to Microsoft's Xbox unit. And as you said, it's a $69 billion deal, which is its biggest by far. In 2016, it bought LinkedIn for $28 billion. It's currently in the middle of buying Nuance for $18 billion. It bought Skype for $8.5 billion in 2011. So this is a massive, massive purchase, and it really shows it's a big bet on this larger VR metaverse world that Facebook is going all in on, and a bunch of these other huge tech companies. Activision shares climbed 30% after the deal was announced, and Microsoft was down less than 2% the last time I looked, around midday. Obviously, we don't really know exactly what's to come of this deal. It still has to go through, and we don't know all of the reasoning behind it, but we can say that it's pretty much a bet on the broader expansion of VR and metaverse type gaming and experience going forward. And just another one of these big purchases Microsoft's continuing to make with its massive cash pile. So it's really, really interesting to see what they'll do with this. At the moment, some of these results will change, obviously, or expectations will change. The numbers we just talked about could change when the deal officially goes through. There's no timetable on this just yet, but with this all in mind, Wall Street appears to think Microsoft shares are pretty much a no-brainer at the moment. So 22 of the 23 brokerage recommendations that Zacks has are at strong buys, with the other at a buy. We should note that Microsoft shares are up 400% in the past 5 years. This easily tops the Zacks tech sector's 160% run, and Microsoft's up about 45% in the past 12 months, and that continued its significant outperformance of tech. Given these strong results, some investors might be worried they quote-unquote already missed out, but that same attitude and mindset would likely have prevented those same investors from buying the stock really at most points in the last several years. So especially for a company like Microsoft that's now just printing money with its cloud computing business and continuing to make these big purchases, if you're a long-term investor, it's likely to continue to grow and grow and grow over years and years and years. At the moment, Microsoft's trading 10% below its records and 15% beneath its Zacks consensus price target. And the stock also hovers somewhat near oversold RSI levels. 30 or under, it's at around 35 at the moment. So it's nearing a price where traders might start to step in. Furthermore, Microsoft is also trading in line with where it was prior to the initial COVID sell-off at 31.8 times forward 12-month earnings. And it's trading right near its own 2-year median in terms of forward 12-month earnings. So its valuation is starting to look better and better. Obviously, most people understand that Microsoft's a no-brainer, one of the biggest companies in the world, but no-brainers might be a good thing to bet on as inflation continues to skyrocket and they're able to have a business that people can't back up on cloud computing. They're not really price sensitive. They have pricing power in the industry, and they're continuing to flex their financial muscles even amid all of the current economic headwinds. So Microsoft might be worth buying ahead of its upcoming earnings release. Some people might want to wait till after, but it's at discounted levels at the moment, especially if you're a long-term investor. And now we're going to move on to a totally different company that works in a totally new, or not new area, but totally different area compared to Microsoft, and that is NextEra Energy, which trades in the ticker NEE, N-E-E, and they are set to report their Q4 FY 2021 results before the opening bell, also next Tuesday on January 25th, so the same date as Microsoft. So NextEra Energy is quietly the country's biggest electric utility and a leader in renewables. This is really seemingly kind of a futuristic stock that also pays a dividend, and it's been far more stable than many of the other quote-unquote clean energy stocks over the last several years. So we're going to go into some of the basics. NextEra owns the largest rate-regulated electric utility in the country, which is Florida Power and Light, serving nearly 6 million customers. The company also, through various subsidiaries, generates clean, emissions-free electricity from several commercial nuclear power plants. NEE is also one of the largest generators of renewable energy from wind and solar, and it's a global leader in battery storage, which is crucial going forward. NextEra and its various subsidiaries slowly grew into the large renewable energy company through strategic planning, including using tax subsidies to help finance wind and solar projects around the U.S. while trying to avoid debt. It also sells output to other utilities because many must get at least some of their power from green sources to meet different government mandates. So that's been a successful business for the company, and will likely continue to be as well. So in 2019, NextEra began its efforts to install more than 30 million solar panels by 2030 to help make Florida a world leader in production of solar energy. And the company already surpassed 40% of that goal earlier this year. So it had till 2030, and it's already nearly halfway there. We should also note that renewable share of U.S. electricity generation is projected to surge from 20% last year to 42% by 2050, and this is based on U.S. Energy Information Administration data, with wind and solar set to be the biggest gainers of that unit. We should also note that it's set to benefit from its nuclear business as the U.S. starts to invest once again more heavily in this clean renewable source as it tries to reach its goals of more renewable energy, and nuclear will have to play a bigger role. And it's starting to come to the forefront again in the U.S. and other places, including places in Europe and in China as well. So on to some other fundamentals. The company topped our Q3 earnings estimates, but it missed on sales, with revenue down about 9% year over year. Overall, Zacks estimates call for its 2021 revenue to dip about 3.5% to around $17.4 billion, with its adjusted earnings still projected to pop 9%. The energy giant's sales are then projected to surge 31% next year, all the way up to about $22.8 billion, which would come in well above its pre-COVID levels of $19 billion. Meanwhile, its adjusted earnings are projected to climb 9% in 2022, and it's also consistently topped our bottom line estimates. With this in mind, as we mentioned, the stock has been really reliable, especially considering the somewhat massive swings of these more pure play renewable energy and solar panel stocks over the last several years. The stock has crushed the utility sector over the past decade. It's up 455%, and it's up 175% in the last 5 years. The stock has cooled off a bit, but it still climbed 90% in the last 3 years to outpace the S&P 500. Its shares at the time hit new highs right after Biden's inauguration in late January of last year. Then went on a bit of a roller coaster ride. It then hit brand new records of over $93 per share right at the end of 2021, so at the end of December. The stock has then tumbled in 2022. It's down over 12% so far, and it was about 2.6% lower the last time I looked Tuesday morning at around $81 a share. So the stock's lightning quick drop has sent it from near overbought RSI levels, so 70 or above there at 66, right into under or oversold territory at 28 at the moment. So it's now somewhat approaching its 200-day moving average, and investors and traders might start to step in soon as some of these technical levels look ripe for the picking. NextEra, which lands as Axric number 3 hold at the moment, is also trading somewhat near its own 5-year median at 30.1 times forward 12-month earnings, and at a 17% discount to its year-long highs. On top of that, its 1.88% dividend yield tops the S&P 500 and matches the recently rising 10-year U.S. Treasury. We should also note that 6 of the 9 brokerage recommendations Zacks has are strong buys, with the others sitting at holds. So all that said, now might be a good time to consider buying this well-diversified clean energy stock, though some might want to wait for its actual report. But it's fallen heavily so far in 2022, and longer-term investors might want to consider this as, in a diversified portfolio, this as one of their more stable dividend-paying clean energy plays. It's also a stable utility company that's not just invested in solar or just invested in wind. It has a nice portfolio of various electricity generation. And now we're going to move on to the last stock on our list, and that is Starbucks, which trades under the ticker SBUX. We should note that the firm is tentatively set to release its Q1 2022 results on February 1st, so 2 weeks from today, but our calendar calls for the stock to release next Tuesday, the 25th of January, and we should note that last year the company reported on the 26th. So at the moment, the company still on their own website is saying it's tentatively scheduled to report on Tuesday the 1st. Our calendar says the 25th. They reported last year on the 26th. Either way, it's going to report in the next several weeks, and it should still be on your radar to buy it maybe before or after earnings. So with this all in mind, Starbucks quickly adapted to the more on-the-go model amid the pandemic, and luckily its order ahead mobile app was already thriving in driving sales well before COVID. We should note that the company, for those of you who might not have heard of Starbucks, which would be nearly impossible, is one of the world's largest coffee companies, and it's a chain that's all over the globe. There's nearly 34,000 stores worldwide. Obviously, COVID did impact its business, just as less people were able to buy coffee at the office. Things were changing so quickly. Its sales were hit particularly hard in China, which was a big growth market for it recently. So overall, its revenue fell 11% in 2020, which was its first year-over-year decline since 2009. Luckily, it did bounce back in a big way in fiscal 2021, with revenue up 24% to $29.1 billion, driven by a 20% increase in comparable store sales. And this came in well above its pre-COVID total of about 26.5. So it reported revenue of $29 billion last year, almost $3 billion above its pre-pandemic total. With that said, the company closed the year on a somewhat disappointing note, with China once again in lockdown mode. Its U.S. same-store sales were up 22% in the fourth quarter and up 11% over its pre-pandemic levels, but same-store sales in the company's crucial China market fell 7% compared to a year ago. And Wall Street seems nervous also about rising labor costs. The company said that its spending on wages will depress its profit margins, and it's expected to then have to boost prices to help compensate for rising labor costs, and also just commodity prices and prices in general around the country and around the globe. Starbucks executives did say labor spending was necessary to attract and retain employees, amid this tight labor market. And it really needs them all to run these complicated orders at these restaurants where you're expected to just churn out drink after drink after drink of sometimes very complicated orders. That said, the coffee chain said that 70% of its U.S. orders are now coming from drive-through or mobile orders. So that could then help it post-pandemic, and then as it's prepared for either a future that kind of continues to look like where people are just getting it on the go, or if people just in a couple of years are just right back to chilling out at coffee shops and back of the offices. It's prepared for either of those. It's also worth noting, as I just mentioned, the complexity of some of these drinks. Executives are trying to reduce that complexity of store operations to help keep its workers, just because there's so many different drinks. I recently watched a video about running a Starbucks store, and it is far more complex than you'd think for a company that essentially just sells coffee. And now in mid-January, chains such as Starbucks and Chipotle are once again temporarily limiting operations in the U.S. at limited individual stores or in regions as they face labor shortages and a rise in COVID cases. Other restaurant operators are also testing positive. So it's just amid the current thing, people are a little nervous about Starbucks, more closures, more workers calling in sick, just still a little uncertainty at the moment. With that said, its sales outlook still looks strong. So our current quarter estimates are calling for 18% top line growth, 30% bottom line growth. For the full year, we're calling for another 12.5% revenue growth, all the way up to nearly $33 billion. And then we're calling for 6.5% growth on the bottom line, as we mentioned. So their rising costs are helping subdue that bottom line growth. And we're calling for another 9% growth next year, and then 17% bottom line growth next year. So continued growth. And these then fall more back in line with how it was doing year over year on the revenue front pre-COVID. It has seen some mixed earnings estimate revision activity recently, and it's a Zacks rank number 3 hold at the moment. And we should note that the company has somewhat consistently beaten our bottom line estimates over the trailing 4 quarters, though it matched exactly last quarter, pulling in $1 in earnings per share. Clearly, though, there are some near-term worries, but Starbucks is not really going to go anywhere, and coffee's never going to go out of style. And Wall Street remains really high in the stock in general, with 13 of the 25 brokerage recommendations. Zacks has at strong buys, with the others at hold. We should note that it's up 300% in the last decade, which includes a sideways stretch from 2015 to 2018. So the stock certainly did suffer setbacks during that period, but now its business is booming again. Mobile ordering is huge. It's only now up 5% in the last 2 years, and it's down 22% from its July records at around $98 per share. The stock is also down 16% already in 2022, and it tumbled well under oversold RSI levels of 30 or under. It's at 23 at the moment, which means investors and traders might start nibbling at the stock soon, kind of no matter what happens. Just at a certain point, these great stocks that are paying dividends and are not going out of business anytime soon and are going to keep having customers no matter what happens in the near future are just going to become kind of too enticing to pass up at some of these levels, especially if the stock continues to fall in the next couple of weeks. We should also note that its current $123 a share Zacks consensus price target marks 25% upside to its current levels, and it's now trading roughly where it was in November of 2020. And we should also note that it's trading at year-long lows in terms of forward earnings, so it's trading at 27.6 times forward 12-month earnings, which is also right around where it was prior to the initial COVID sell-off, so that valuation is starting to look more enticing again as well. And the downturn has boosted its dividend yield to about 2%, so it's topping the 10-year U.S. Treasury. All in all, like with all these companies, longer-term investors might want to consider it as a part of a well-diversified portfolio, and it's just been beaten down so far so quickly in 2022, and these might just be based on more near-term setbacks. So with all of these stocks, you might want to hold off until after they report, but you might want to put them on either your watch list or your radar to consider buying in the next several weeks, especially if they continue to fall further eventually people are just going to step in and buy these great stocks at discounts, especially if you're a long-term investor. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.